I'm Yana. Welcome to my channel. If you clicked on this video, it means you are either interested to learn about investing or are ready to start investing. Either way, congratulations. It's a big step. In this video, I'm going to walk you through the entire process of investing. I'll explain the investing terms so you can understand the investing language, investing options like stocks and index funds, and at the end, I'll also walk you through some low-risk and low-cost investment options as well as pre-investment checklists so you can finally pull the trigger. So stick around, as I guarantee at the end of this video, you'll feel more confident to start an exciting journey of building wealth. And meanwhile, please subscribe to my channel to never miss out on any personal finance tips. Firstly, I understand if you feel worried or unsure about the whole investing thing. I've heard stories myself about investing and losing money. And yes, I'm not gonna hide there is some risk involved in investing. But at the same time, you keep losing money every day if you are not investing it. And with smart investing, you can choose low-risk options and actually grow your money. But by choosing to keep your money under the mattress, meaning just sitting there in your bank account, you're essentially losing it to the inflation. Inflation is the rate at which the cost of living increases over time. And the unfortunate truth is that the salaries do not keep up with the increase of the cost of living. Which means that due to the inflation, you keep losing your buying power. As the chart shows here, the cost of groceries is up by almost 20% since 2021. So I'm sure you have felt the impact of inflation yourself. And the historic trend unfortunately shows that when the prices go up, they usually stay like that and never go down to the old prices. Now to illustrate this, if you keep saving $1,000 each month for the next 15 years, you'll have saved $150,000, which in 15 years might not have the same buying power as today. Like maybe 10 years ago, you could buy more stuff with $100 than today. But if you invest $1,000 on a monthly basis in a low-cost index fund, and I'll explain what index fund is later in this video, in 15 years, it will grow to around $349,000. So it will double up and you'll increase your buying power. Or if you let it compound for 30 years, then it will grow to up to $1.5 million. But if you just keep it under the mattress, after 30 years, you would have saved up only $300,000. But you could have spent $300,000 to get $1.5 million. Big difference. So as you can see, simply just saving it is riskier than investing. Now, since we cleared this aspect, let's move on to the investing options and understand some investing language. Now, first, let's talk about investing options. You have an option of buying individual stocks or index funds. Let's understand the key difference between investing in individual stocks versus index funds. This is one of the crucial points to understand in investing, as it also includes the risk factor. When you buy a stock, you own a piece of the company that issues it. You become a part owner, and you'll generally make money if the company does well, or lose money if it doesn't. Most of the money you make will come either through increases in share price or through dividend payments. There are essentially two ways of buying stocks. It's either you buy an individual stock, like for example, you buy a stock of Amazon. So you own a little piece of this big company, or you buy stocks through index funds that can include hundreds or thousands of different stocks. Now let's understand what is an index fund. An index fund is like a ready-made package of investments that lets you own a little bit of many different companies without having to choose which ones to buy yourself. Think about it as buying a mixed bag of candies instead of picking just one. If you buy a stock, you essentially buy just one candy. But with index fund, you buy a bag full of different candies. Instead of trying to guess which individual stocks will do well, an index fund automatically includes a bunch of different stocks or other assets. For example, it might include shares of popular companies like Apple, Google, Microsoft, and many others. By investing in an index fund, you're essentially buying a tiny piece of all those companies at once. And in general, it's considered less risky in comparison to buying individual stocks. Because you don't want to depend on performance of just one company. And let's face it, if this company doesn't do well, you go down with it. But with owning a package that includes different companies, you take on less risk because it provides you with diversification, which is another term in investing, basically meaning don't put all your eggs in one basket. In the United States, most of the popular indexes are the S&P 500, which represents 500 of the largest publicly traded companies in the United States that are doing extremely great. And it includes companies like Apple, Amazon, Facebook, Microsoft, Google, and many others. Next is the US total stock market, the Nasdaq 100, and the Dow Jones Industrial Average. So you can pick to invest in an index fund that tracks any of these indexes. When choosing which index fund to invest in, you need to consider the expense ratio. The expense ratios are annual fees that investors pay to cover a fund's expenses such as management and marketing. Expense ratios are subtracted automatically, making them easy to miss. For example, if you were to invest into Fidelity 500 index fund, here as you can see, the expense ratio is 0.015%. So if you invest $1,000, you would annually pay only 15 cents. This is a great expense ratio. Make sure to be careful about the expense rate. For example, if you see an expense rate of 1% or 2%, it might not seem a lot. but it does make a difference when your money is compounded over the years. And what is a compound interest? It simply means earning interest on interest. It's an important term in investing. Compounding adds up fast and it's the easiest way to build wealth. As promised, I'm going to share with you a few great index funds that I personally like. There's the Vanguard 500 Index Fund that has a minimum investment requirement of $3,000. Its expense ratio is 0.04%. Then Schwab S&P 500 Index has no minimum investment requirement. The expense ratio is 0.02%. And lastly, Fidelity 500 Index Fund has no minimum investment requirement and the expense ratio is 0.015%. All of these track the S&P 500 Index and are very popular choices. Please make sure to make your own research and see what works best for you. For beginners, I'd recommend to start with a small amount and continue educating yourself so you can make informed decisions as you increase your investment amount and start investing in different assets. Now, a quick checklist before you invest your first $100 or $1,000. Make sure that every point is checked so you can be absolutely ready. Number 1, you have no high interest debt. Your credit cards and personal loans are fully paid off. If you have high interest debt, you should make a goal to pay it off before you start investing. Watch my video about bad money habits and how to overcome them, as it covers this point. I'll link it in the description below. Second, you need to be current on your student loans and mortgage payments. These loans don't count as high interest debt, so you shouldn't be too much worried about paying them off fast as long as you are on the schedule. They also provide some tax benefits, but you need to be current on your payments. Number 3, you saved enough for emergencies. A lot of people skip this point, but it's really important. It's recommended to have in your savings account 3 to 6 months worth of living expenses to cover unexpected expenses due to layoff, car repairs, medical emergencies, and etc. If you don't have savings for emergencies, make a plan to save up and only then start investing. For example, if you want to build an emergency fund of $10,000 by saving $700 per month, you can achieve this goal in approximately 14 months. And lastly, you have educated yourself enough to make informed investment decisions. So read books and watch videos to educate yourself. This was the part 1 of Investing for Beginners series. In my next video, I'll explain about the tax-advantaged investing options, which refers to retirement plans. I'll explain in detail about all of this in my next video. So make sure to subscribe to my channel if you haven't yet and hit the notification bell to be notified every time I post a new video. And if you enjoyed this video, please give it a like as it really helps me with my channel. Thanks for watching.